Welcome to Growth Wealth Code, where we explain investing concepts in a simple way. Have you ever wondered why some people put their money into a regular mutual fund, while others talk about parking their money in a hedge fund with a minimum investment of millions of dollars? Is one actually better than the other? Or is this just about who has more money to begin with? In this video, we're going to break down what a mutual fund is, what a hedge fund is, why they might look similar on the surface but are actually very different underneath, and most importantly, which one actually makes sense for you, whoever you are. But first of all, this video does not contain any financial advice. Everything I share here is purely for educational purposes, so you can understand the concept before you make any decisions on your own. A lot of beginners, when they first hear the word fund, immediately picture something exclusive, complicated, and only for the wealthy. But the truth is, mutual funds are actually designed for everyday people. Hedge funds, on the other hand, are a completely different story. Let's break it down. Picture this. You and your friends are chipping in to buy food for a birthday party. Everyone contributes a little bit of money, and one trusted person, let's call them the organizer, goes shopping and divides everything fairly based on how much each person put in. Nobody has to go to the store themselves. Nobody needs to know how to cook. Everyone just trusts the organizer to manage things well. That, in a nutshell, is how a mutual fund works. Money from thousands, even millions of investors gets pooled together, then managed by a professional fund manager who buys a mix of stocks, bonds, or other assets based on a predetermined strategy. You don't need to be a stock market expert to participate. You just contribute your money and let the professionals handle it. Now imagine a different version of that party. There's a small group of people, let's say just 10 of them, and each one has a significant amount of money. They're not just splitting the cost of regular food. They hire the best private chef in town and give them complete freedom to experiment with expensive ingredients, risky techniques, even ingredients that might not work out, all with the hope that the results will be far more spectacular than an ordinary party. But if it fails, they're also prepared to absorb much bigger losses. That's a simplified picture of a hedge fund. Money pooled from investors with substantial wealth, usually institutions or high-net-worth individuals known as accredited investors, is managed with a much more aggressive and flexible strategy. Hedge funds can short sell, use leverage to amplify their positions, invest in highly illiquid assets, and even speculate in complex derivatives. All of this is done with one goal in mind: chasing returns that are significantly higher than the market average. So why does this happen? Why do these two types of funds operate under such different rules? The answer comes down to regulation. Mutual funds are heavily overseen by the SEC because these products are open to the public, including everyday people who might be investing for the very first time. Because of that, mutual funds are restricted in what fund managers can and can't do to keep risk manageable and transparent. There are regular disclosures, diversification requirements, and limits on how much leverage can be used. Hedge funds sit on the other end of the spectrum. Because hedge fund investors are considered sophisticated enough to understand the risks and wealthy enough to absorb potential losses, the regulations are much looser. That flexibility is exactly what allows hedge funds to pursue exotic strategies that a regular mutual fund simply isn't allowed to touch. Now let's look at some real numbers, so this feels more concrete. To get into a mutual fund, you can start with a very small amount. Plenty of mutual funds let you begin with just a few $100s, and some even allow automatic monthly contributions of $50 or $100. The fees are also relatively affordable, typically shown as an expense ratio somewhere between 0.03% for a basic index fund and 1 to 2% for actively managed funds. So if you invest $10,000, your annual fee might only be $3 to $200 depending on the fund. Hedge funds are a completely different story. Minimum investments usually start in the hundreds of thousands of dollars, often $1 million or more. Their fee structure is famously known as 2 and 20, a 2% annual management fee on total assets, plus 20% of any profits as a performance fee. So if a hedge fund generates a big return, the manager takes a significant cut of that upside before it ever reaches you. Let's talk about a real example. Remember long-term capital management back in the late 90s? This hedge fund was run by a group of brilliant financial minds, including 2 Nobel Prize winners in economics. Their strategy was incredibly sophisticated, using massive leverage to amplify returns. For a few years, the results were spectacular. But when the Russian financial crisis hit in 1998, their strategy collapsed within weeks. And the losses were so severe they threatened to destabilize the entire global financial system, forcing the Federal Reserve to step in and coordinate a bailout. Now compare that to a mutual fund like an S&P 500 index fund. During that same crisis, index funds did drop too, but they never came close to threatening the stability of the whole system. Because the structure is simpler, more diversified, and doesn't rely on extreme leverage. But here's the catch. That doesn't mean hedge funds are always bad and mutual funds are always safe. I'm not saying one is better than the other, just pointing out how differently they're built from the ground up. Mutual funds tend to make sense if you're investing for the long term, want more predictable risk, affordable fees, and high liquidity, meaning you can sell whenever you actually need the cash. They're a solid fit for retirement savings, a kid's college fund, or other long-term financial goals. Hedge funds, on the other hand, are built for investors who already have significant wealth, understand high risk, and are looking for strategies beyond traditional stocks and bonds, maybe to hedge a portfolio during a downturn, or to chase returns that don't move in step with the broader market. Now let's talk about the psychological trap that shows up here a lot. Plenty of beginners see headlines about hedge funds generating incredible returns in a short amount of time and start thinking, why am I stuck in a boring mutual fund when there's a faster way to get rich? This is a dangerous way of thinking. Here's the truth. The majority of hedge funds over the long run actually underperform simple index funds once you factor in those hefty fees. There's a famous case where Warren Buffett made a 10-year bet against a hand-picked group of hedge funds, wagering that a plain S&P 500 index fund would beat the combined performance of those hedge funds after fees. Buffett won, and it wasn't even close. Not because hedge fund managers aren't smart, but because that heavy fee structure eats up a huge chunk of the returns that should be going to investors. It's not about timing the market, it's about time in the market. This principle applies whether you're in a mutual fund or a hedge fund. Patience and consistency remain the real keys, not how exclusive or expensive the product you're using happens to be. So if you're just starting your investing journey, and your account doesn't have 7 figures in it yet, mutual funds and especially low-cost index funds are usually a much more realistic and historically proven choice. Not because hedge funds are bad, but because their fee structure and risk profile are simply designed for a very different kind of investor than most of us. But again, this all comes down to your financial goals, your risk tolerance, and your investment timeline. There's no one-size-fits-all answer here. What matters most is that you truly understand what you're getting into, not just following the crowd because something sounds exclusive or impressive. If you're still a beginner and not sure where to start, the simplest and most historically proven path is starting with a low-cost index fund, sticking to consistent dollar-cost averaging, and letting time do the heavy lifting. There's no need to rush into complicated strategies before you fully understand the basics. If you found this helpful, hit like and subscribe to Growth Wealth Code so you don't miss our other personal finance videos. And if you liked this one, you'll probably enjoy our previous video on index funds versus ETFs, and which one makes more sense for beginners. See you in the next video, and remember, it's not about who has access to the most exclusive product. It's about who's disciplined enough to stick to their plan,